Welcome to Real Estate is Taxing, where we talk about all things real estate tax and break down complex concepts into understandable, entertaining tax topics. My name is Natalie Kolodij. I'm your host, and I am so excited that you've decided to join me. One of the most common driving factors I hear from many real estate investors, business owners, etc., for why they got into the business to begin with is to create a lifestyle that would allow them to spend more time with their family and create future wealth for their children. Now, I myself am out here living this childless millennial lifestyle where all of my time and money I can spend on whatever I would like, but I realize that there are many people who went a different route and have kids. Those who do have children, especially those with a business, have really taken to the idea of teaching their kids responsibility, fiscal responsibility, teaching them about money as a whole, and wanting them to build these same skills that allowed them and their business to create this lifestyle and this opportunity for their kids. Whether you are a landlord, a small business owner, a large business owner, or a legal or tax professional who works with any of the above, you are going to want to listen to today's episode because this can be a game changer for you. Today, we are talking about how someone can employ their children in their business. This is a fantastic strategy to save money, to help them prepare for retirement, to teach them responsibility and ethics. There are countless reasons that this is an incredibly popular strategy. However, it is also a strategy that has a ton of misinformation available. So today we are going to talk through the requirements for employing your children, the benefits of doing so, and the reasons you need to avoid some of the common misconceptions about doing this. As a starting point, the first benefit to employing children in your business is giving an opportunity to have them grow up learning the business. It'll help teach them about responsibility, it'll give them that structure, and if the plan is to have them take over one day, it really helps bring them into things at a young age. Looking more to the financial side of things, there is a fantastic benefit in the tax code that allows parents to employ their children who are under 18 in their business and not have to pay payroll taxes on the wages they pay them. So this offers a really unique opportunity. When we take this idea and pair it with the secondary fact that someone who earns less than the standard deduction in a year is not required to file a tax return and they won't have any taxable income, what we have created is a situation where a parent can pay their child up to the standard deduction for doing work in their business, and then the child, as long as that is under that standard deduction, does not have to file a tax return and does not have to pay any taxes. So this has created a fantastic opportunity to accomplish several different things. The first item that this provides as a benefit is the opportunity to shift income from the parent's higher tax bracket over to a 0% tax rate for being under the child's income. The next opportunity is allowing children to fund a Roth IRA at a much younger age than they would typically start. There is a huge time value of money, and getting to begin funding that while they're still little can really have a tremendous benefit in the long term. With these undeniable benefits, it's no wonder people are all encouraging every business owner they know to employ their kids. So we are going to start off today's episode by walking through the advantages of employing this strategy, but you're going to want to stick around to the end because I am also going to walk through the common mistakes and why they can be costly and end up blowing up this whole strategy for a taxpayer. As an initial benefit, there can be a substantial amount of tax savings based on someone employing their children. This is because we can pay each child up to the standard deduction for doing work for the business. For 2024, that amount is $14,600. So if someone has 2 children, that is close to $30,000 that we can potentially reduce their taxable business income by, and we're effectively shifting it over to a 0% tax rate under the children. If the parents are going to be at, say, a 22% effective tax rate for the year, reducing their income by $14,600 effectively results in a savings of around $3,000. So if they have multiple children and we're employing multiple children and shifting this amount more than once, that tax savings just increases from there. So the first key benefit is tax savings for employing your children in the business by shifting income from the higher tax bracket of the adults over to the tax-free rate of the children. The next benefit that this puts into place, that to me is, I would argue, the greatest benefit, is having earned income will allow that child to fund a Roth IRA. Now, the earlier someone can start investing, the more they will have at retirement, right? We've all seen the charts that tell you how much you need to contribute per year at what age to end up with $1 million at retirement, etc. The younger you start, the less it costs overall because of the time value of money. So if a child starts funding a Roth IRA account when they're 8 or 9 years old, instead of starting when they're 18 or in their 20s when they get their first job, this is going to allow them to have a tremendous advantage over where the average person starts off when it comes to retirement investing. If a child is able to put around $6,500 a year into a Roth IRA, starting at the time they're 8 years old, by the time they're an adult, once they hit 18, they should have close to 6 figures in that account. That is more than many people into their 20s have saved for retirement. So having the opportunity to start that retirement account for your children early is such a huge advantage, and that can't be done without them having earned income. These two things combined create a fantastic benefit, and there's really not many downsides as long as the compliance is done correctly. So let's move on to the less fun part of what is required to do this correctly so it doesn't end up falling apart for you. The first requirement is that you are going to be employing your child. So what this means is they have to actually be an employee and treated in the same way the business would treat any other employee. This means they have to actually do work for the business. That child cannot be doing household chores or other around the house tasks. The child also needs to actually do the work. You can't just say you're paying them for X number of hours that they didn't do. It has to be treated the same way as any other employee. They also need to actually be paid for the work. You can't just say you're paying them. You still have to actually pay them the way you would pay any other employee. And finally, they have to be paid a reasonable wage for the work they're doing, the same general amount that you would pay any other employee. The reason I like to emphasize this part is there's a lot of gray area in people's minds. So what these facts really emphasize is you have to treat them as though you hired any other person off the street to do this work for you. So what that means is if the minimum wage for where you live is $15 an hour or $17 an hour, and the role you're hiring them to do, the tasks they're going to complete, are really simple things that someone who has a pretty minimal skill set, as a child would, are able to complete, then you need to be paying them close to that minimum wage. You cannot just choose to pay your 10-year-old $100 an hour when you could have hired any other employee to do those same tasks for $20 an hour. So you have to pay them a reasonable wage for the work they're doing, and they actually have to do the work, and it actually has to be in the business. The next common mistake that creates a ton of headaches when this comes up in court cases is not having valid documentation and reasonable tracking the way a business would for another employee. So, at the start of the episode, we talked about the benefit of getting to move up to $14,600 over to being tax-free. We just covered the fact that you have to pay your child a reasonable amount. So if you are paying them $17 an hour, that equates to working over 400 hours during the year to reach that $14,600 amount. If we split that up across 52 weeks, that's around 8 hours a week that the child would have to work. This may or may not be reasonable, depending on their age, depending on the business, etc. It doesn't have to be spread evenly across all 52 weeks. What we see a lot is where children are on summer break, they'll work more hours and then it pulls back while they're in school. But just be mindful that if a child is 10 years old, there's not a good chance that they are working 8 valid hours of work every single week for a business. So it does have to be all reasonable and justified. One of the most common reasons this is disallowed when it's looked at by the IRS and in court cases is because they just select an amount to pay the children, and there's no justification for how they got there. They're just choosing $14,000 because they know it's the max. There is no justification for the tasks they're doing, the hours they work, how old they are, their skill set, etc. So that is the first very common mistake that you are going to want to avoid, is do not just pay them the maximum. Make sure you are actually paying them for work they do at a wage that is reasonable for work they do, and that you are keeping track of it. Even though they are your child, even more so because they're your child, you should have them keep a time log of their hours worked, the same way you would have any other employee clock in and clock out. The next mistake that we hear about pretty frequently is that you can do this no matter what, that anyone can pay their kids and not pay payroll taxes on those wages they're paying them, and that's as deep as it goes. There is a limitation to what type of entity can do this strategy while avoiding payroll tax. If the children are paid from a business that is operated as a sole proprietor, a single member LLC, or a partnership, a multi-member LLC, where the only partners are the parents, then they are able to pay those minor children without incurring any payroll taxes. However, if they are paying the children out of an S corporation or a C corporation, they will still be subject to payroll taxes. So it's incredibly important to make sure that before you employ this strategy, you understand the full tax impact it's going to have on you, as well as the filing requirements and remission requirements for sending in self-employment tax that you might be subject to. So don't just assume because they're your kids, there won't be any taxes owed for payroll tax. It is going to depend on your business structure. And lastly, what I would argue is probably the most common mistake that comes up with this strategy is two-part. People are either under the assumption that they do not need to provide their children with any kind of a form to document their pay, either a W-2, a 1099, etc. There are people who think nothing is required to be filed because we know the child won't have to file a tax return. So why do we give them a form if we know they're not going to have to do anything with it? Well, this is because whether an employee has a filing requirement and whether you as an employer have a legal requirement to file a form are completely unrelated. So even if that is your child and you know they won't need to take that form and do anything with it, that doesn't matter. You as the operating business still have the same exact requirements to submit any required documentation and forms as you would if you were employing a total stranger. So you do still have to issue quarterly reports. So you still do have those requirements as the employer. Part 2 to this misconception, and this I think is what I see the very most often that creates the biggest issue, is many people believe that they should or can, or the correct way is to 1099 their children. I don't know why this is thought to be the best way to do this. I'm assuming because it's less work on the employer. Oh, just issue them a 1099, that's one form, instead of having to file payroll reports monthly or quarterly or annually, etc. However, if you remember at the beginning of the episode, we said that a child can make up to the standard deduction of $14,600 and not have to file a tax return. That is not the case if someone has self-employment income, and someone who receives a 1099 for work they do is self-employed. If someone has self-employment income, they need to file their own tax return if they earn any more than $400. So if you have paid your child $12,000 during the year, and then at the end of the year you issue them a 1099 and you think nothing has to happen, that's incorrect. And now they would need to file their own tax return to report that 1099, and they are going to have self-employment income, a Schedule C business, subject to self-employment tax. So at the surface, issuing a 1099 instead of a W-2 is going to create a much worse outcome for no reason. It's just going to make things worse. In addition to this, the IRS has very specific requirements with who can be classified as a 1099 independent contractor versus who is a W-2 employee. So if we read over those requirements for who can be a 1099 contractor, the IRS notes that the general rule is that an individual is an independent contractor if the payer has the right to control or direct only the result of the work and not what will be done and how and when it will be done. You are not an independent contractor if you perform services that can be controlled by an employer, what will be done and how it will be done. This applies even if you are given freedom of action. What matters is that the employer has the legal right to control the details of how the services are performed. Do you think that a 10-year-old is going to have all of the freedom of operating their own business outside of the end result? Do you think a parent is going to tell a 10-year-old, your task, what we need you to do, I'll pay you $5,000 to go completely clean this property in between tenants, and you are actually going to do this for all of our short-term rentals, use whatever products you want, go whenever you want, take as long as you want, do whatever systems you want to use, you choose how any of this happens, but we're paying you $5,000 to clean all of our rentals? No, The parent is probably going to go to a rental with their 10-year-old and say, the broom is over there, please sweep for me, or you wipe down everything in this bathroom using these products. A child is likely not going to meet the requirements to be a 1099 independent contractor. This strategy is called employing your kids because you literally have to employ your kids. So not only will they not qualify to be treated as a 1099 contractor, in doing so, you are creating a worse tax situation than if you had just done it correctly and treated them as a W-2 employee for the work they do. Additionally, one of the risks of incorrectly paying someone as a 1099 contractor when they should have been an employee based on all facts and circumstances is if this is ever audited and the IRS reclassifies that to W-2 wages, which is what it should have been the whole time, you are now going to be subject to a whole slew of penalties and interest for not having paid payroll reports on time, not having submitted the tax on time, etc. Your child who is employed by your business as an employee. This means that you should do all of the standard requirements you would do for any other employee. You are going to want to have an employment contract. You are going to want them to track their time. You are going to have to file those payroll reports. And you are going to want to issue them a W-2 at the end of the year. Even if they're not doing anything with that form, even if you don't owe any payroll tax, none of that removes the requirement of you as a business to still file those reports. And that's the correct way to do this. The final item that we spoke about as a benefit earlier was funding that Roth IRA for your children and how much of a huge benefit that is because they have this time to build the value of their retirement accounts. Part of that requirement is them having earned income. If you are not issuing them any forms, or if you're incorrectly issuing them a 1099 and not following, etc., if they don't have a tax return filed showing they have earned income, and if you didn't issue any kind of formal documentation reporting correctly their earned income, there is no way to prove that they had earned income, really. You didn't legally follow the steps to report it. If that is ever looked at by the IRS and those fundings that go into their Roth IRA are disallowed, that's going to blow up the whole plan and create a whole slew of issues for you. To recap today's episode, we covered the benefits. Employing your children allows you to shift income from your higher bracket as an adult over to being 0% taxable to them. You can potentially pay them up to the standard deduction each year. They won't have to file a tax return. They won't have to pay tax. And they can start funding a Roth IRA with those funds from the age where they start having earned income, giving them a huge head start on retirement. The risks and cautions. You do have to actually pay them for work in the business, not private household chores. They need to actually do the work. They need to be paid for the work. They need to be paid a reasonable amount for the work. You are also going to want to have an employment contract, have them have a time clock where they're tracking their hours, and you as the employer should still file all of the required payroll reports and W-2, even if there's no tax owed on any payroll taxes. The last warning is you do not want to issue the child a 1099. This is incorrect reporting. They don't qualify to be a 1099 independent contractor. If this is ever looked at and the IRS reclassifies it as wages, you will have a ton of penalties and interest. And if someone receives a 1099, then the amount they can earn before having to file a tax return drops down from $14,600 to $400. Then you are likely to not file a tax return for the child because you didn't know you had to. That's going to result in late filing penalties. It opens up an entire arena of penalties and issues and headaches for doing this the wrong way. Employing your kids is a fantastic strategy. Anyone who has children and has either a business or rental properties should look into doing this. Just do it the right way. Set them up as an employee, and don't try to default to moving over the maximum you can. Do it correctly and set them up for reasonable earnings year to year. This can increase as they get older, and either way, you're still going to be in a better tax position and be setting up your child for a fantastic advantage by starting to fund a Roth IRA at a much younger age. So, as always, I hope you got some value from this episode. If you know someone who has children and has a business, or you know someone who started implementing this strategy but is not doing it correctly, please share this episode with them so that they can get things straightened out and take advantage of this tremendous benefit in the tax code without having risks that are sitting out there. As always, if you're enjoying the podcast, please give it a 5-star rating. Even if you don't know someone with kids and a business, I would love if you would share an episode that you got value from anyway. And I will talk to you next week.